The RBI's Monetary Policy Committee meeting from April 4th to 6th has suddenly become very important, especially after the tariff blow from the United States. As always, CNBC TV 18's Citizens Monetary Policy Committee is meeting to deliberate on the issues that the Reserve Bank's MPC will deliberate. I have with me the chairman of our committee, Dr. Pranab Sen, and members Soumyakanti Ghosh, Sajid Chinoy, Samiran Chakraborty, and Sonal Verma. Gentlemen and Sonal, thank you very much indeed for your time. As I said, it's the global situation that's most important. So, Sajid, let me start with you on that issue. We have this tariff blow and we have this very weak jobs data. We also have the most important player in the global scene, literally changing the rules every night with a tweet. So, at such a situation, what should the MPC be prepared in terms of global impulses?
Thank you, Lata. I think it's important to recognize that the global economy is at a very critical inflection point. One can look at the first half of the year and get lulled into complacency because growth has been surprisingly strong in the first half of the year. Second quarter global growth is tracking 2.5%, which is above trend. But that strength is deceptive because it's being driven by transitory factors. One of the reasons that growth has been resilient the first 6 months is because there's been record volumes of front-loading exports to the US in anticipation of higher tariffs. We've seen lots of transshipment where Chinese exports to the US have actually gone through third countries in Asia with lower tariffs. We've seen China's policy stimulus being front-loaded this year. And most importantly, the actual realized tariff rate in the US in June has been less than 10% because it takes time for the final rate to go up. So we've seen an effective rate of only 10%, whereas given the slew of announcements made in the last 48 hours, the effective rate is going to settle somewhere closer to 18 or 20%. So expect to see over the next few months a meaningful increase in the effective rate that US consumers feel. Now, already we've begun to see that below this, strength on the surface, there are cracks emerging. You spoke about the jobs report. What was most important is the last 3 months now, US private hiring is only averaging 52,000 jobs per month. That's clearly sending you a signal that US businesses are already being impacted by the uncertainty that you alluded to. And hiring has reached a stall speed. When these tariff rates go up from 10 to 18, that's going to be a substantial purchasing power squeeze. So my message is, don't be fooled by the strength of the US, of the global economy in the first half and the US economy in the first half. The second half is going to be much weaker. I'll end by saying, however, this means that central bank easing will be brought forward. We now expect that the Fed will, most likely move in September itself. And remember, even though US inflation may go up, the rest of the world is going to be beset with more disinflation. Think of a dam where the US puts on a tariff wall. It's like a dam, and the water that used to go to the US and now is blocked is going to flood the rest of the world. So the Chinese excess capacity will go to other parts of the world, be disinflationary. And the fact that you have lower growth prospects, lower inflation, and a weaker dollar should pave the way for central banks around the world as well to begin easing in response to the growth shock that's coming.
Okay. Growth shock. Let me toss that to Soumya. Soumya, can you parse that for the Indian economy? At the moment, we have not seen very weak growth numbers when you look at some of the PMI numbers, but the tax data that came in last week, it came in a couple of days back, did not look too good. I think tax collections have been negative on personal income tax, understandably, even corporate income tax, very, very weak. So is there more growth weakness that we should prepare for?
Yeah, I think Lata, just to take it a little bit forward with the Sajid's argument, yes, the growth has been weak, and continuing the same vein what Sajid said about the global growth. I think for Indian economy, if you look into the trends as of today, I think it will throw up two contrasting trends. While the first quarter GDP number, which is going to be announced towards the end of August, could actually surprisingly see a strong number, but that will be more of a statistical artifact, because what has happened is that in the last couple of months, there has been a significant deceleration in prices. So that could actually pull down the deflator, and you could see a peculiar situation where the nominal growth and the GDP growth actually, and the real GDP growth could actually converge. But that, in essence, is not the story. We can actually get a very different set of numbers going forward if you look into the momentum. If you look into the momentum of the two-wheeler sales, if you look into the momentum of the electricity consumption, if you look into the momentum of the corporate results, if you look into the GST collections, all numbers are actually showing a significant deceleration trend. And the important point is that in tandem with the global growth numbers, which will look better in the first half, Indian growth numbers will also look better, possibly in the first quarter, maybe a little more in the next 3 months. But the second half is actually going to be diametrically divergent. So, in my sense, I think if we are looking into the data, we should be very clear that this will be a story of two halves. The first half
Oh.
would be strong, but because of reasons which could be statistical artifact or otherwise, and the second half could be relatively weak compared to the first half. So looking forward, I think there is going to be some impact on the growth given the way things have been unfolding.
Okay. So even if not inflation, growth could be a reason for the Reserve Bank to go soft. That's your point, right? Sonal, let me get the inflation numbers out. I did a poll, and now the new number seems to be even below 3% average for the year. So does that give the Reserve Bank, a clear elbow room to cut?
Yeah, Lata, I think the balance of risk, both to growth and inflation projections of the RBI, are clearly to the downside. And on inflation specifically, our own projection is for a 2.8% for FY26. I think if we break up inflation into the food versus the core trajectory, the core underlying trends, so stripping out the impact of the commodities like gold, petrol, diesel, the underlying momentum has actually been around 3.5% for the last 24 months. This is the longest stretch of soft, subdued core we've seen for a while. And given the forward outlook on Chinese excess capacity or the domestic demand pressures, we do think this is going to stay benign. Now, on the inflation front as well, the what we are basically seeing is both on vegetable prices, despite the sequential increase, and on pulses, the deflation actually continue going forward. So when we combine the overall prospects, we do think that the risk is that inflation will in fact undershoot the 2%, the lower bound, for most part of this calendar year, and for the full financial year actually be less than 3%, as you said. The final point I do want to flag is, that obviously, from a monetary policy perspective, is the forward trajectory on inflation that is important. And the 1 year forward inflation, at a number of, let's say 4.5% would suggest that we are close to target. But we need to keep in mind that part of the uptick in inflation 1 year forward is also because of adverse base effect. And the underlying momentum is actually very benign. And I would say the momentum is actually in the 3.5% to 4% range. So both the near-term undershoot and the 1 year forward actually do suggest that there is space and elbow room, as you said, to cut rates.
This is going to be the polemics of the Reserve Bank's internal discussion. When the governor spoke to our channel, spoke to me, he kept referring to the inflation outlook. Likewise, in a subsequent public discourse as well, he is worried about the inflation going forward. So, Samiran, that's question to you. It is very clear from our poll and from what all of you are saying, inflation is going to average below 3%. But should the RBI look at the current inflation or look at the year ahead inflation? As Sonal is pointing out, that has its own pitfalls. You tell us.
In a sense, the kind of summer decline in inflation has been much more than what was anticipated before, and the RBI's projection of 3.7% in the June policy needs to be lowered substantially, and we'll have to see how much RBI lowers it. But the debate really is not only about the timing of the decline in inflation today versus how the inflation is going to look 9, 12 months ahead, but also about what is causing this inflation to fall. So at the moment, it appears that most of the inflation fall is coming from food prices, although it's quite broad based across cereals as well as the summer seasonal increase in vegetable prices has been much less. But it's always very unclear that how and when these shocks can come back. We have built in significant buffers in our food inflation projection for the rest of the year. And on the other hand, core inflation, which has been running extremely low for almost 2 years now, even if we assume some upside to that, we'll probably reach somewhere around 4.5 inflation for the Jan March quarter. But we must also understand that the current inflation is benefiting from significant favorable base. Similarly, that Jan March quarter inflation will suffer from unfavorable base. So you adjust for base, then actually inflation could be just about 4%. So the added twist in the whole issue is that we might have a new inflation series sometime early next year. So it's becoming extremely difficult to have a projection of 9 to 12 months ahead inflation in a very reasonable way. So I suspect in the current circumstances, tracking something like an average inflation is a better idea, and RBI will have to take a call where that average inflation is going to be and then try to calculate some sort of a real rate out of it.
Oh, you have a point. We quite forgot about the new series that will hit us. And so this 1 year forward, we'll have to take into account something which we don't even know, how it will pan out, because food weightage will go down in that series, at least by a few percentage points in terms of weight. Dr. Sen, the other big question is, if you are going to cut, is it better to cut in August or in October? Is it better to wait?
Well, this is the thing. The point that Sajid that made, which is you're seeing a huge amount of global uncertainty. Now, in a context of that kind, the question is, we don't have much ammunition left in our belts. So the question really is that do you take action now preemptively, or do you wait to see how things pan out in the relatively near future, next couple of months? Because Mr. Trump is going to be making calls on a daily basis, as he's been doing in the last few days. So things can change quite dramatically. And therefore, at the moment, we've just done a large rate cut in June. I think we should be a little cautious in terms of reacting at the moment, because there are too many uncertainties that's being caused by Mr. Trump's style of functioning. So I would say that it's probably better to hold off a little bit, because there's still time for the last rate cut to play itself out in the market.
Okay. Well, I'll want more opinions on that. Let me take a quick break. We are back with more questions, also questions on liquidity and where the Reserve Bank should keep the call rate. Back in a jiffy.
मुथूट फाइनेंस गोल्ड लोन सुनहरी सोच प्रोग्राम में आप सबका बहुत